All right, hello again, everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our options trade of the week. We're going to do something a little bit different with the video here today. We're going to talk through a trade that has gone against us. We're going to take a look at the trade that we talked through in last week's video on Tesla. It has not done what we expected, and we're underwater, so I want to talk you through how to defend a losing position. Let's face it, there's a lot of experts on YouTube and Facebook, Twitter, Instagram, everybody talking about the big winners. But what happens when a trade goes against you? There are a few guarantees in trading, but one thing I can guarantee is you will have trades that go against you. You're going to have losing trades over time. It's just part of being a trader. So it's all about how we handle those losing trades. The nice part about being active in the options markets, there are things that we can do to defend a losing position. Potentially roll the position further out in time to give it more time to play out in our favor. So I want to walk you through the different options that you have to manage a losing trade. So like I said, we're going to talk through Tesla. We're going to take a look at the trade that we broke down in last week's video. If you have not had a chance to go through that video, I recommend that you go back and do so. And make sure you subscribe to the channel. That way you're notified anytime that we post a video, any type of an update or new trade. We want to make sure that you get notified. So on Tesla, we talked about the 130-minute chart in last week's video. We like to look for near-term areas of extremes, overbought and oversold conditions. In this case, we have had a market that has been pretty impressive over the last 2 weeks. We've had a huge bounce market-wide, and a lot of that move has been led by the tech sector. Tesla being a big component of the move to the upside. When we came in last week, we were talking about this move to the upside, leading to this overbought condition on our pulse indicator now at the bottom. We had yellow and green bars on the upside. What that indicates is that price is between a 1 and a 2 standard deviation move on the upside. In other words, we're very overbought. When you start to see a 1, a 2 standard deviation move, or even past it, you know that only 2% of all occurrences fall outside of that range on the upside. It doesn't mean it can't happen. It just means it's not statistically probable. What we did is we sold an out of the money call spread with the expectation that Tesla was either going to enter a period of consolidation or even give us a nice healthy pullback. Well, even though it wasn't statistically probable, it happened. This happened to be one of those outlier moves. Even doesn't happen all that often. In this case on Tesla, overbought got even more overbought here this week. You can see we had a gap to the upside. It has continued to move higher. And now we have price up around the $1,100 mark. We have the pulse indicator that has returned into the green section here. We've had a whole slew all week. We have had green bars on the pulse. Right? That means that price is between a 2 and a 3 standard deviation move. In many cases, when you go back historically and you see this many green bars on the pulse, in most cases, you're getting very near an area of exhaustion. It does not mean that I expect Tesla to make this huge move to the downside. I just expect the pace on the upside to slow. I think we're going to see a period of consolidation here in the near term, a potential pullback. My outlook hasn't changed. The bottom line is the trade that we put on last week, obviously we were early, right? The move has not played out. So now let's go over to the trade page and let's talk through how we manage the trade from last week and potentially look at a new trade here this week. So I'm going to jump on over to the trade page. And the trade, if you go back to the video from last week, we were taking a look at the April 8 weekly options. Those options still have 8 days left to expiration. It's this expiration right here. And what we did is we sold the 1,055 call and we bought the 1,060 call. We're just trading two options at the same time. It is a vertical spread. Now, we opened the trade last week for $1.75. $175 per spread is what we collected. That was our maximum profit potential. With it being a $5 wide spread, there's a $5 difference between the strikes. It meant that we were tying up $325 of capital. That's our maximum loss in the trade. If the trade went dead against us, the most that we were going to lose was $325 per spread. All right, so now we take a look at it. The trade has gone against us. Ideally, we wanted the stock to stay below 1,055. It has not done so. Right? It's now $40 above the call option that we sold. That spread is now trading for around $3. It's kind of bouncing around in here between $3.15 and $3.50. Markets are pretty active here while I'm recording this video. So now we're down money. What do I do? Well, there's a couple of different options that we have. We could simply just close out of the position and take the loss. We could hold on to the position and for the next 8 days, just hope that markets pull back and Tesla starts to sell off. Now, Captain Obvious, I know, right? Our options close it or hold it, right? Seems very basic. But let's talk through when you would do each of those. If I were to close the position and just take the loss, I would do so if my outlook has changed on Tesla. If I go over to the chart and just say, hey, it's just a runaway freight train on the upside. I don't want to get in front of that freight train again. I'm just going to lick my wounds, take the loss, and move on to the next trade. In many cases, I would do that if that was my outlook, that the stock was going to continue to move higher, or if there was a big upcoming news event, if we had an earnings release upcoming, or if we had an upcoming Fed statement. Those are typically events that I like to avoid. And if that was the case, I would definitely lean towards just closing out of the position and taking the loss. The second option would just be to hold for the next 8 days to see if it does pull back. I would do that if I looked at the chart and saw that, hey, the extreme is still there. My outlook hasn't changed. I'm just going to give it a little bit more time. Now, if I were to hold, let's take a look at some additional numbers to see how probable is it for that stock to get back down to 1,055 over the next 8 days. If I take a look at the April 8 options, I'm in the Thinkorswim platform. Over on the right-hand side, you're going to see that at the April 8 options, right now, there's about a 68.5% implied volatility being used to price the options. In other words, over the next 8 days, the market makers are pricing in around a $90 move on the stock, higher or lower. It's not going to tell you whether it's moving higher or lower. It's just telling you the range that's being priced in to those options. Well, if I'm going to hold, I need about a $40 move. At initial glance, you're saying a $40 move in Tesla, it seems like a lot. But when you take a look at the numbers, there's almost a $90 move being priced in to the options between now and next week. It still is possible for the stock to pull back, right? And if you wanted to hold and potentially wait for that pullback, I wouldn't have an issue with that. Okay, the 1,055 calls that we are short, there is a 37% chance of that option closing out of the money. That's what we need to have happen. 37% chance, not, it's not a high probability, but you can see there's still a chance for that happening. How much additional risk do I have on the trade? If it's depending on where you get filled at, you still got, at this point, you still have a little bit of additional risk. Right now, I can take a partial loss. The maximum risk on this trade is $325. Okay, that's the most that I can lose on the trade. Right now, based on our fill price, okay, we have an additional 150, depending on your fill price, between $150 and $200 of additional risk on the trade if you hold. Okay, so I wouldn't be opposed if you wanted to hold the position. But we have a third option here. There's a third way that I can manage this trade, and it's called rolling the position. When I talk about rolling the position in its simplest form, all I'm talking about doing is closing out of our existing position that we're looking at here on the screen and looking to open up a new position further out in time. Maybe I go out an additional week, an additional 2 weeks. By rolling the position further out, I have the ability to give the trade more time for that pullback to happen in my favor. And I potentially have the ability to adjust my strike prices. Instead of just going out an additional week or two and selling the 1,055, 1,060 call spread again, I could potentially move my strikes further out of the money. That way I just increase my probability of being successful on that second trade. Now, when would I roll the position? Rolling a position is not necessarily going to leave you with a profit overall. Okay, if you roll the position, you take a look at both trades, you're going to take a loss on the first trade, you could potentially win on the second trade. Even if that happens, it doesn't necessarily mean that you're going to have a profit overall. In many cases, you're going to be left with a partial loss. The idea of rolling the position is a completely defensive position. I'm trying to defend a losing position, trying to limit the damage and potentially battle back from that losing trade. All right. So a lot of times people roll positions and then they get disappointed that, hey, I'm still taking a loss on the overall trade. In many cases, the way that we roll positions, that's going to happen. But at this point, the original trade has gone against us. There's nothing I can do to change that at this point. Bottom line is the market just didn't accommodate us in this situation. So now what can I do to limit the damage? So what I would do if we were to close the trade out right now, and right now at the time of this video, we're trading, you can see markets are all over the place. And let's just say for our example that we get filled at $3.05. If we get filled at $3.05, it would leave us with a loss of $130 per spread. Okay. Not fun to lose money. Okay. No fun to look at a loss and lock in a loss, but it's part of trading. And we know we have to learn how to take a loss and how to battle back. If this is a $130 loss, obviously it's not going to wipe out an account, right? If we can limit the damage, it allows us to battle back faster. So now if I take the loss on this trade, how do I roll the position? Well, now I need to decide how far out do I want to go? Do I go out an additional week? Do I go out an additional month? In this case, because I look at Tesla and I see a very significant overbought extreme, I'm not expecting Tesla to completely fall apart over the months to come. I'm expecting in the near term, over the next week or two, that we could potentially see a pullback. So to give myself a little bit more time, I could go out to the April monthly options with 14 days left. That just gives me an additional 6 days. If I open those up, let me take a look at selling another out of the money call spread. So now I'm just taking a look at a brand new call spread, trying to collect some additional premium, move my strikes further out of the money to see if I can battle back. All right, so I'm going to go out to, let's go out to the 1,120 call. It's this one right here. If I right click on that one, go to sell and go to vertical, it's going to pop up a brand new $5 wide spread down at the bottom where I'm selling the 1,120 call, buying the 1,125 call, and this one's trading for $2, right around $2 mid price. Okay, let's just move it up to $2 and lock in the price. And let's just say for this example, that's where we're able to get filled. If I click on confirm and send, this is a trade where I'm taking on $300 of additional risk, right? This is not going to be a free trade. I've got to take additional risk to see if I can battle back. I would be risking $300 to make $200. Okay, that $200, that is my max profit on the trade, right? I have 5 ways of making money, just like we talked about last week. I make money if the stock moves up, down, or sideways, as long as price stays below 1,120. It's currently trading for 1,095. Okay, so we've got a little bit of wiggle room here. Right, it could continue to move to the upside, and I'm okay with that as long as price stays below 1,120. I also make money from time decay adding up and from volatility decreasing. Those are the 5 routes that I have of making money on this position. In a perfect scenario, in a perfect world, we would get a pullback very early, either tomorrow or even into early next week. If that happens, we're going to make money pretty quickly on this new trade. If we don't get a big pullback, if price just kind of sits here and consolidates, I can work with that. I just have to hold longer and let more time decay add up in our favor. All right. So now we took a $130 loss on the original position. I just collected another $200 to put on this new trade. This is going to potentially leave me, depending on how this new trade plays out, it could potentially leave me with a partial profit, a partial loss overall. It's just a way of defending the trade. The only time that you're going to want to roll the position is if your outlook has not changed. If you come in and look at that chart and say, look, I gave it a shot to pull back, Tesla just didn't do so, I don't want to fight it anymore, I don't have a problem if you just close it out and take a loss. Like we talked about, that was the first option. The other 2 options, hold it into next week, just seeing if we can finally get a pullback. You could do so. But in this case, because my outlook hasn't changed, the stock is still overbought. We just need to give it more time to pull back. I'm going to roll the position. I have to be comfortable taking on additional risk. I'm fine with that. And let's just see over the next 14 days, can we finally get that pullback in Tesla? So if we get filled at $2, my target zone on this one, I want to close out between 50 and 75% of the max profit. So if I can close this thing out for between 50 and a dollar, 50 cents and a dollar, that would allow me to take the profit, move on to the next trade. Okay? And we'll track this one. I'll jump back on next week. We'll walk you through this new rolled position in more detail, see if this one ends up working out in our favor. So hopefully that made sense. Hopefully that gives you some insight into how to handle a losing trade on an option position. The nice part is we do have flexibility. We do have multiple routes that we can go to defend a losing trade. So as always, if you have any questions, feel free to post a comment here on the video. You can always email me directly, mike@netpicks.com. I am more than willing to help out there as well. And as I mentioned earlier, make sure you subscribe to our channel. That way you're notified anytime that we post a video. We always appreciate that. So I'm going to wrap this video up here, guys. I'll jump back on next week for our next options trade of the week, and we'll also take a look at Tesla at that point as well. All right, we'll talk to you then.